Okay, so with all the different possibilities, investing seems a bit of a gamble. Um, it can seem that way, and I suppose it's a couple of things with that. So, in the very short term, I would agree with you, really. Investing in the short term, we nobody really knows, as I kind of alluded to with our analogy of what might happen in 2024. It's difficult to tell what could happen in the very short term. And so what I would say is you have to kind of lengthen out, elongate your timescales. So if you look at a minimum of a 5 year period, actually the situation looks really different. So when you're investing, you're really looking at a minimum of a 5 year time horizon. So it's important to know that when you invest, you have to have at least five, if not 10 years, 20 years. The longer you go, the better. 10 years, you've never lost money, even after inflation, over a 10-year period if you invest properly over a decent amount of time. Um, and so it becomes less of a gamble if you think of a long-term picture. You know, if you invest over 5 years and you invest in a relatively adventurous portfolio that's invested in shares, funds, um, there's a pretty good opportunity that you're going to make money over the longer term. So, yes, in the short term, it's a bit of a gamble, but you don't invest over the short term, you invest over the long term. Also, I would invest in quality. So when I say quality, I mean that you invest in companies, portfolio managers that have got a long track record, a large, have got a big team of people. You don't want to be looking at the next big thing or what you've heard or what your mate down the pub's recommended or what you've read in the newspaper. We spend a lot of time and energy and money really researching and monitoring our portfolio managers to ensure that they're doing their job and they're performing in line with what we expect them to do. So you want companies with a long track record. You don't want companies that have just sprung up or looking for the next returns that just don't seem feasible. So that's definitely something to watch out for. And another thing would be, so we've got costs, sorry, not cost, we've got, well, cost as well. Cost is important. We use a kind of a blend of tracker and active management. So our portfolios use trackers where we feel that active managers can't really provide any value. So it tends to be the developed markets, but we use active managers where there's less research, where there's more opportunities. So it's a blend really between cost and performance. Um, and it's important really that you are really well diversified as well. So as I alluded to in the initial chat, different parts of the world might react differently to different medicine. You know, like America did superbly well last year. We don't know whether they're going to do really well this year. China and emerging markets did poorly this last year. Perhaps they're going to recover this year. UK, same. So um, it's difficult to tell what could happen depending on events around the world. So this is why you're really well diversified, both geographically, both investing in funds. So each individual, so to give you an example, our portfolios have 30 to 35 funds within the portfolio, and each fund has 80 to 100 shares in it. So you're really well diversified, both geographically and spread across different regions and different types of companies, smaller companies, larger companies. And then for those that don't want to take the full investment risk of investing in share funds, you invest in different asset classes like bonds and cash savings accounts, gilts, property, different asset classes that can act as a buffer to the short-term volatility of the stock market if you feel that's more comfortable for you. So um, that's quite a long answer to that question, but it can be a gamble, but not if you take advice and have a kind of a longer term view on it, really. I hope that's answered that. Uh, why invest when I can get 5% on my savings and not have any charges or fees? Thanks for that. So really here we're talking about having money in the bank, the long-term investing. So the first thing to say is that it's fact that the if you invest your money over the long term, you earn more or you get more returns than leaving your money in the bank. That's just fact really over historical records. So if you're investing if you have a long-term perspective and you invest properly, um, you've always done better than cash savings over the longer term. In the very short term, I kind of get where you're coming from. Interest rate right have risen over the last year or so to make interest money in the bank. We've had years and years of virtually zero savings rates. So I can see that in the very short term that yes, they're looking a bit more attractive than they did before. But even in the short term, if inflation starts to come down, as I said, markets are already factoring in a 1% cut, in interest rates this year. So it's likely that interest rates are going to come down already next year. And as a result of that cut in interest rates, it will mean that we get these sudden sporadic surges in the stock market. I had this conversation with a client in, I think November, late November. And in the time that we got back together again in January, the markets had gone up by more than he would have got in his kind of 4% savings account. So um, the advice really is to stay invested, stay the course, and not be swung too much by kind of short-term decisions about what can happen at this moment. Yes, there's going to be some fees applicable to investing, your advisor fee, your fund manager's fee, but the returns net of all those fees have always produced a much higher return than kind of leaving your money on the sidelines, not really doing anything. Cash has got an important role, in the short term. Have your money in the bank, have savings accounts for emergencies and for short-term needs. But if you've got a 5, 10, 15, 20-year time horizon, if you've got money in pensions, ISAs for grandchildren's education, retirement goals, you don't want to be sitting in cash on the sidelines. That's what will kind of drag your returns, over the longer term. Okay. My stocks and shares ISA keeps going down. What's the point of investing? Well, I've got a cheery lot on today, haven't I? Again, you're probably looking at the short term. So, what kind of time horizons are you looking at? Are you looking at it from month to month? Are you looking at it quarter to quarter? Are you looking at it from year to year? Or are you looking at it from 5-year time horizons? Are you looking at a 10-year time horizon? So, if you could just put down what kind of timescales you're talking about, that might be useful because, and I'll keep sharing this screen, but it's just useful. So yeah, so I mean, even on that graph there, if you look at the green one, the one that's just in the stock market, so if you invested, you could argue if you invested in February 2023 and it's kind of gone down and it's kind of getting towards the end of the year, maybe your statement came out in November. You can look at any kind of time horizons. Look if you invested in, where's that? Early 2022 to late kind of mid 2023. You can see there's a downturn there. So I am not suggesting that investments can't go down. We know that investments can go down in the short term. Um, yeah, so so you've had a statement through in November. So you're looking at 6 months. You had a statement through. Yeah, okay. So you're looking too short term, really. It's a longer term investment that we need to be looking at. It's like if you buy your house. I got clients that bought their houses in the 60s and 70s, and you just don't think about it for 30, 40, 50 years. And of course, over time, things kind of grow over time. So I think just have that kind of longer term perspective. Be patient. Don't fret in the short term. Probably best not to kind of keep looking at the valuations and looking at the statements as they come in. Ensure that you're either kind of know what you're doing, or you're taking advice and you're investing in quality portfolio managers, because there are an array of quality out there. So always have the best of the best, the ones that have got the track records and the performance. But mainly, I just kind of stick in there, really, stick in there for the long term. Okay. I'm interested in ethical investing. Do you do ethical investing? Yes, we do. We're completely independent, so we don't have any kind of affiliations, or we're not tied to recommend any particular investment. In terms of ethical, we do our due diligence and research in exactly the same way as mainstream investments. I personally think that's those thematic type investments, the ones that are going to look at environment, population changes as the population gets older. I think that's where it's going to go the next 10, 20, 30 years. So I'm definitely quite positive about those kinds of investments. It's a bit of a can of worms, because when people say ethical, can mean pretty much anything. If you've got a very specific requirement, or you looking to invest in specific companies that you're particularly interested in, perhaps we have that facility. We have a stockbroking facility for that, that we can recommend a trusted partner for that. Or if it's more mainstream ethical, if you like, we can look to see whether you're positively ethically minded, which would be that we can invest in any companies or anywhere around the world, but as long as they've got a strong corporate governance and they're looking to do positive things within their particular industry. Or you could be negatively ethical and that means that you specifically want to not invest, say, in tobacco or alcohol or such like. So just come in really for an initial chat. We'll take you through what we mean by that kind of different recommendations, and then we can kind of go from there really in terms of what you mean by ethical. Okay, what are our charges? Okay, so good question. We have an initial meeting which is free of charge, so you can, if anything like this kind of sounds interesting, or you're looking to invest, or you've got pensions that you've got no idea what you're invested in, or that kind of thing, or if you've got investment goals that you need help with, I just urge you to come in. We're on the High Street in Westbury. We're very welcoming and warm firm. I'm sure you're aware. You just come in. It's a living room style office, which I'm sitting in just now, and we have an initial chat for an hour where I'll go through your circumstances, your tax situation, your financial goals, and then I'd go through your financial circumstances, and then we would take that information away with us and do all of our research and work on your specific plan. You haven't paid anything yet. That's all kind of complimentary. We take the charge for that. And then if you are the second, third, fourth meeting, we can deliberate over our recommendations. If you decide to go ahead with an investment or a portfolio, or we take over your existing arrangements, we have a fixed 1% initial fee, which covers all the kind of initial work, and then we have an ongoing 1% fee on the portfolio that we're managing for you, and that really pays for all of your ongoing service and meetings and research. Clients come in minimum annually for their annual review, where we'll take them through what's been going on with their investments and their in the world of tech, tax and financial planning, and they'll update us with what's going on with them. So it's quite a good kind of process that we have, an annual process. Everything that we do really is to build ongoing relationships with clients. So and most of the time they'll pop in whenever they want anyway. So we're here. The whole reason why I built the firm was to have this kind of open door policy where we can see people whenever we want, whenever you have a query. If you've got a problem with the paperwork, you come in and there's a whole team here, to help you. So yeah, we're on the High Street in Westbury, and we'll be kind of happy to see you. Um, what specific investment manager are you recommending at the moment? So we are completely independent, so we're not tied. One of the things to look out for is that if you are um, looking for an advisor, you don't want them that is tied or they have to, or you get railroaded into a certain specific product. Make sure they're completely independent. So, because that's really important because you want to know that, going forward, if there's a problem or there's a change of recommendation, that the advisor's going to follow through with that and going to be motivated to do the best for you as a client. Um, Really, it's just on the back of the first meeting. So you might be ethically minded, you might be a higher investment risk type person, you might not want to take any risk. It really depends on the first meeting where we get to know you, get to know your investment goals, get to know your past experiences, get to know how you tick. Really, this is why we have a kind of a face-to-face style business. We want to get to know you. We want to get to know the family. We want to get to know what we want to get you completely. So it's only really at the end of that meeting where we can kind of properly ascertain and go away and have a lie down in a dark room and really think properly about what you want as a client, and then we'll present to you what we feel is right for you at the second meeting, and then go with that kind of longer term. But as I said, that investment recommendations can change. We don't look to continually change every year, but if we feel there's something better out there for you, that would come out in our review meetings with you. So difficult to say exactly what we would do for you. So really, just kind of come in for an initial meeting. Um, Someone's put a comment. What I've got no idea what my pension is invested in. Yeah, we do get that a lot. Um, I get the third degree really in terms of what that people's ISA is invested in, but people have got no idea what their pension is invested in, and that's often sometimes their biggest asset, or certainly their second biggest asset outside their house is their pension. So um, just come in for a review. It's not just about the investments either within the pension. It's about pension tax rules, the lifetime allowance. A lot going on over the last year in terms of pension tax rules. We've got a budget coming up March the 6th, so we need to kind of address any changes, maybe change of government. So all of these kind of come out as part of the ongoing review process. So you don't have to worry really about all that kind of stuff. We give you that peace of mind to know that you're invested in the right place for your individual goals. And then ultimately, it's to how most tax efficiently and how best, according to your circumstances, to take that pension for your retirement. So if you haven't got a clue what's in your pension, or you're just a bit unsure, or you just don't like, or you just don't enjoy looking at these things, bring it in, because this is the sort of thing that we do on a daily basis. I don't have any more questions now. That was really good. Thank you so much for sending them in on this early start. It's absolutely freezing this morning. I was even going to wear my hat, but I did take it off at the last minute because I thought that I'd look a bit silly on a investment webinar with a big woolly hat on. So I think I'm going to finish up there. So I hope that's been really useful for everyone. It is a complex area. There's lots of changes going on. I do understand that, but that's really why we're here, to take that off your shoulders. And as I said, in order to get going, perhaps start of January, new goals, new incentives, new ideas, get back in touch, or get in touch with Laura in the office, and we can have an initial meeting. Okay. Have a great day. Thank you. Thanks for joining. Thank you. Bye-bye. Bye.